You're watching Business Incorporated live on Channels Television. Coming up in the next 25 minutes, Zambia announces debt restructuring agreement with a creditor group holding its international bonds. Tanzania set to merge 19 state-owned entities into 7. And S&P Global has revised down the long-term credit ratings for 3 Egyptian banks. Hello, welcome to the program. Ladi Williams. First off, let's get a check on major markets we track right here on the African continent. We see at intraday, major equities are down with the EGX 30, the lone gainer right there. We see Nigeria's NGX marginally down at intraday, 0.01%, while South Africa's index is down big 0.65%. But in North Africa, we see EGX bucking the trend right there, 0.99%, about 1% up, while Kenya closed down 1.32% yesterday. And West Africa Capital Market Conference, WACMAC 2023, was held yesterday with the theme Infrastructural Deficit and Sustainable Financing in an Integrated West Africa Capital Market. The 2-day event, which is the largest gathering of capital market policymakers and brokers and other stakeholders, is jointly hosted by the West Africa Securities Regulators Association and Economic Community of West African States, ECOWAS, and the West African Capital Market Integration Council, WACMIC. Take a listen. It is the 3rd edition of the West Africa Capital Market Conference, and this time it's being held in Lagos, Nigeria. The 2-day event drew capital market regulators and stakeholders across the West African sub-region to deliberate on ways to tackle infrastructure deficit as well as embrace principles of sustainable finance. Vice President Senator Kashim Shettima was represented by the Special Advisor to the President on Economic Affairs, Mr. Tokwe Fashua, says that the infrastructural deficits in the country and the sub-region are better tackled by domestic capital market and not only foreign borrowing.
If this is so for Nigeria, it presupposes that the entire region has similar or perhaps larger infrastructural deficit waiting to be filled. They are better filled from inside, not through foreign borrowing alone. The job of the capital market in Nigeria and of course West Africa is therefore cut out for it. And this extends to West Africa and Africa at large. Thank you.
On his part, the Lagos State Governor, Mr. Babajide Sanwo-Olu, acknowledged the role of the capital market in providing long-term finance.
And so hosting this prestigious conference in Lagos offers us a unique opportunity to showcase our economic mettle, our rich cultural heritage, and our warm, very warm Lagos hospitality. We hope that the events will not only foster greater integration and capital market formation, but also stimulate tourism potentials and attract even more investors to our region.
The Director General of the Securities and Exchange Commission and Chairman of the West Africa Securities Regulators Association gives his expectation on the outcome of this year's gathering.
We are confident that this event, themed Infrastructure Deficit and Sustainable Financing in an Integrated West Africa Capital Market, will foster integration, encourage capital formation, promote tourism, and attract investors to our region.
As a flagship program of West Africa Securities Regulators Association, the West Africa Capital Market Conference is a biannual event that seeks to present the West African region and the continent the opportunity to address important issues related to the orderly growth and development of the regional and continental capital markets. All right, let's get a quick check now on the Middle Eastern markets. I would see it's mostly negative sentiment. In the UAE, Abu Dhabi index is down 0.62%, while the Dubai index big 1.32% down. Other markets we track in the Middle East, Saudi Arabia and Qatar. The Qatari index, that's the biggest down at intraday, 1.69% down, while Saudi Arabia is down 0.61%. A lot of pressure right there in the Middle Eastern markets that we track. Let's take it on to London now. Let's get a check on earnings in the UK. Juliana joins us now for this. Great to have you, Juliana. So Unilever has reported underlying sales growth of about 5.2% for the 3rd quarter of the year. How are the markets receiving this earnings report?
Good afternoon, Laddie. Not great, actually. In fact, the FTSE 100 firm has seen their share price dip 2.5% this morning. And that's because, as you say, they've just released their third quarter updates. In fact, this is the first quarterly profit update from the consumer goods giant's new CEO, Hein Shoemaker. He took over Alan Jope earlier this year after a failed COVID acquisition deal. And unfortunately, it's not gone too well because their sales have dipped 3.8% in the 3 months to the end of September to 15.2 billion euros. Of course, that's still a lot of money, but not really for Unilever because, of course, they dominate the consumer goods industry. In fact, most people can't look around their home without seeing a product that's owned by Unilever, including Dove soap and Marmite, which is a popular commodity here in the UK. Now, they have blamed this on high interest rates, which has actually pushed up some of their bottom line, but it's not trickled down to consumers. Consumers are holding back. So what Shoemaker has said to shareholders this morning is that basically the performance hasn't really matched their potential. What they now want to do is focus their attention on 30 of their key brands, and I think that accounts for about 70% of their market share. So not great from Unilever. Still, their sales are robust, but revenue is weaker. And they also mentioned that nutrition isn't doing well, and neither is ice cream. So lots of people holding back on ice cream, Laddie, as they're suffering through cost of living.
Yeah, I understand perfectly, but I will not let go of ice cream at this time. I'm a big fan. But let's look at other stories. That was the UK's largest mortgage lender expects house prices to fall this year and next before rising in about 2025. How's this being received over there in the UK?
Yeah, it's pretty interesting, actually. This has come from the Halifax owner Lloyds Banking Group, who have put out this forecast about the UK housing sector alongside their third quarter financial results. Of course, we're bang in the middle of third quarter results at the moment. They've been trickling in, particularly from UK banks. Lloyds reported a rise in pre-tax profits to £1.9 billion. And a lot of this is because of high interest rates, right? Interest rates in the UK are at 5.25%, which is a 15-year high. So, of course, that's lifted up the profitability of banks. So they've been doing exceptionally well over the past quarter. But because of high interest rates, mortgage rates, too, are also rising. And this has had a massive impact on the UK housing sector because prospective buyers are putting off that first purchase because they're not sure where they can get the best for their buck, because mortgage rates are constantly going up and down in the UK. And that is one of the reasons why Lloyds have put out this forecast saying that they do expect there to be a significant drop this year. I believe they say 4.7%, and they don't expect house prices in the UK to lift until 2025. So for some people, that's good, because we know it is incredibly difficult to get on the housing ladder here in the UK. I do believe that the average price for a UK home is about £300,000. If you want to live in London, again, the British capital where I am, you're going to have to spend at least £500,000. So it's a lot of money, and because of the cost of living crisis, because of erratic interest rates, people are putting off those purchases. But this, of course, does have an effect on the overall economy. So I think now there are calls for the Chancellor, Jeremy Hunt, to kind of put in or pull in some of these bank bosses to see what they can do to try and offer more palatable, affordable mortgage products for prospective buyers, first-time buyers, so that the housing market can be buoyant again. Worth mentioning, though, that even though house prices are dipping, they are still £40,000 higher than they were during pre-COVID times in the UK. So dipping, but still incredibly expensive.
I think we need more dips to that £40,000 level. But how are the markets in the UK looking?
Not great, still very much in the red. Red is the colour of the markets at intraday. The all-share is down, Laddie. It's down by 0.47%. The FTSE 100 down by 0.53%. And the FTSE 250, the domestic market, that's down by 0.36%, mostly due to retail sales. We've got retail sales data showing that retail sales are dipping. Not great as we head into the all-important Christmas season for retailers there. In the currencies market, the British pound also down against the US dollar, down by 0.20%, although the pound is up against the euro at intraday by 0.06%, but down against the Japanese yen by 0.08%, Laddie.
All right, Juliana, red is caller right there in the UK. Thank you so much for the update. All right, let's get a check on Europe now. See, Amazon Web Services is launching a sovereign cloud service in Europe aimed at governments and customers in highly regulated industries. This move comes as Amazon looks to address strict regulations companies and public sector organizations have in the European Union. For more on this, we'll turn to Deutsche Welle's Cassandra Sundt right there in Berlin. Great to have you, Cassandra. So how is this cloud different than services already offered by Amazon?
Thanks for having me, Lottie. So the difference here is that the AWS European Sovereign Cloud will be located in and operate out of Europe. Amazon says that it will have the same security, availability, and performance as existing AWS regions, but will be separate. This cloud will let customers keep all metadata that they create to stay within the European Union, and it will have its own billing and usage metering system. So this is all to say that it's a service designed to address concerns here in Europe about, quote, digital sovereignty. Now, that's not a terribly well-defined term, but broadly speaking, it's the idea that the EU should be in control of its own data and technology. And it's related to a bid by the EU to boost European developed critical technology and to have strict rules over the storage and transfer of data.
And the different data regulatory rules in the US and Europe has caused tension in the past. Can you remind us of what led to this moment?
That's right. Washington and Brussels were at odds over this for years. The EU is essentially concerned about the reliance on foreign, but in particular US firms when it comes to cloud computing in the bloc. Europe has attempted to counter the growing size of cloud giants through an initiative called Gaia X. The aim of that is to connect different services within this region. A lot of this follows the Edward Snowden revelations from a decade ago, where Snowden revealed that US and British intelligence agencies had successfully broken or circumvented much of tech companies' online encryption, allowing the National Security Agency in the US, for example, to begin collecting millions of emails and chat records. So since then, 2 earlier data transfer agreements were thrown out. Then the EU signed off this summer on a new framework for data privacy. The framework lays out the standards to make sure that there's a, quote, adequate level of protection between the US and EU when it comes to data privacy.
All right, let's turn to the markets now. What are investors taking a look at today?
European stock markets opened sharply lower on Thursday after losses elsewhere. The London FTSE 100 fell 0.8%. Some movers so far today in London include Unilever, which met market expectations for third quarter sales growth after raising prices, though it has failed to win back shoppers who have traded down to cheaper products. As a result, its shares fell just over 3%. Overall, the personal care, drug, and grocery stores index lost 1.9% there. The broader banks index also fell 3.1%, while over in the Eurozone, the Frankfurt DAX index sank 1.4%, and the Paris CAC 40 shed 1.2%.
So, red is caller right there in Europe. Thank you so much, Cassandra Sundt, right there from Berlin. Thank you. All right, South Africa's Minister of Trade, Industry and Competition, Mr. Ibrahim Patel, says the African Growth and Opportunity Act, AGOA, is vitally important for the economic development of the African continent. Patel was briefing media on South Africa's readiness to host the AGOA Forum scheduled for November 2nd to the 4th, 2023. Take a listen.
The official logo you will see here behind us, and you'll see the 3 elements of the partnership. South Africa as the formal host, the United States as the partner, and the African continent as the other co-hosts, because we're really hosting this on behalf of the continent. We've had a meeting with African trade ministers in December last year, where we developed a common position on AGOA, and we've had similar meetings between African ambassadors in Washington, D.C., in which they too have worked together on a common position. And so this will be an opportunity for us in the forum to share those views with the United States. Africa and South Africa provides an enormous quantity of the raw materials that is fueling American industrialization. And South Africa alone is the single biggest provider of a number of critical minerals to the US. Of course, similarly, we benefit from American technology, from know-how, and from the jobs that are created here.
And we must say that for the first time in the AGOA summit, for the first time, organized labor will now be included, as the minister has alluded to. And it would be ourselves in South Africa, but also in the African continent with our counterparts in the United States in relation to trade unions that would also be having a platform to meet and also take our resolve to the main session, so that also business and government are able in civil society to understand what labor thinks of these trade relations.
Welcome back. Let's get a check on livestock market right here in Nigeria. See, the price of beef has risen significantly in the past year to about 4,500 naira per kilogram this month, from 3,500 kilogram in October 2022. However, this price increase of 22.86% is lower than the current food inflation rate of 30.64%. For more now, joining us is Miriam Ode, analyst at FDC. Great to have you on the show, Miriam.
Good afternoon, Adi. Thank you for having me.
Right. So, Miriam, no surprises here. Everything is expensive right now. But what factors are behind the rise in the price of beef, and why is it increasing at a slower pace than the majority of other food basket items?
Yeah, Adi. So, like you said, in the past year, the price of beef has actually increased by 22%. And this is due to a number of factors, including higher transportation costs that is not even only affecting beef or most other commodities. And then we're seeing the effect of climate change, which is affecting the feeding patterns of the cattle and in turn affecting the supply of beef. And then there's still the issue of rapid population growth in Nigeria. And as suppliers are still even battling with meeting the already existing demand for the commodity, we can see that this rapid population growth is actually a problem for them. But we're not seeing these factors causing a spike in the price of beef, mainly because of the slowing demand in this market, which is brought on by the availability of cheaper substitutes. And at a time when consumers' income is shrinking, everybody wants to buy what is cheaper, but will still create or will give the same value. So this is why we're seeing slower demand in this market, and consumers are opting for cheaper sources of protein like eggs and crayfish. And then there's also increased government intervention or efforts in this sector. And most cattle rearers in Nigeria practice a pastoral system of cattle rearing, which involves just little input but can create a substantial increase in output levels. So that's why we're seeing that this increased government intervention is actually going a long way in increasing the supply of cattle and beef. And this is why we're seeing a limited level of price increase in the beef market.
Like this Christmas is going to be the most expensive, ever at this point. But we have the cattle herders and farmer clashes at this point. How's that affecting that market right now? Do we expect stability in the cattle market?
Yes, we know that most cattle are bred in northern Nigeria and only migrate down to the south for feeding purposes. So this isn't tension between this isn't conflict between the herdsmen and the farmers in the north would definitely influence beef prices in the near term and could even possibly cause them to decline. But let's not forget that the World Bank has forecasted that Nigeria would experience catastrophic levels of food insecurity brought on by flooding and various other factors in 2023. And this could offset the easing conflicts in the north and could even could even increase the level of price instability in this beef market in Nigeria.
All right, thank you so much, Miriam Ode. We'll keep tracking those prices, see how they play out this Christmas. Thank you so much for coming on the show.
No problem. Thank you for having me, Ladi.
All right, still here in Nigeria, see the federal government is promising to ensure an enabling environment that will attract investment to enhance domestic gas utilization and infrastructure. Minister of State for Petroleum Resources and Gas, Mr. Ekperikpe Ekpo, stated this during the second edition of Domestic Gas and Gas Infrastructure Summit in Abuja. According to the minister, strategic intervention frameworks such as the Midstream and Downstream Gas Infrastructure Fund are already bridging the infrastructure gap. Take a listen.
Experts from the oil and gas industry and top officials of the Abuja Chamber of Commerce and Industry are participating in the second edition of the Domestic Gas and Gas Infrastructure Summit. The theme of the meeting is building a sustainable, resilient gas and renewable energy sector in Nigeria and beyond, and it aims at boosting the contribution of gas to the nation's socio-economic development.
Implementation of Petroleum Industry Act, PIA 2021, marks a watershed moment. The Act frameworks on strategic interventions such as the Midstream and Downstream Gas Infrastructure Fund is already bridging the gap infrastructure that has been existing, fostering an environment that attracts investment, innovation, crucial for expanding our domestic gas utilization and infrastructure.
As we navigate through the complexities of transitioning into a sustainable future, it is imperative that we focus on harnessing our abundant resources in the most efficient and effective manner possible. The domestic gas sector presents a unique opportunity for us to diversify our economy, create jobs, and reduce carbon emissions.
The rising global demand for cleaner energy sources continues to offer Nigeria an opportunity to explore the benefits of gas resources for the nation's development, an opportunity that the government plans to take advantage of.
For us as a Chamber of Commerce, we take advantage of whatever will benefit the business community, improve economic growth, drive investments, and provide much-needed jobs for Nigerians. We are glad that this present administration has pledged an unalloyed commitment to leverage the domestic gas utilization, processing, and international export of Nigeria's massive gas resources.
Already, the federal government has confirmed interest from Libya and Turkey for the supply of Nigeria's natural gas.
And to all the stories now, see Zambia's finance ministry has reached an agreement in principle, debt restructuring terms, with a creditor group holding its international bonds, a milestone. It's drawn-out debt rework process. The agreement will see the three existing bonds restructured into the new amortizing bonds maturing in 2035 and 2053, respectively. And Zambia's inflation rate is near as a two-year high, and as the currency actually tumbles, consumer price rose 12.6% in October from 12% in September. While the kwacha is trading at a 27-month low despite the bondholder deal. Zambian inflation accelerated at the fastest pace in almost 2 years in October as the kwacha continues to tumble, bringing pressure to bear on the central bank to raise interest rates next month. And Tanzania has to merge 19 state-owned entities into 7. Decision comes 2 months since President Samia Suluhu Hassan gave her approval for reforming those parastatals and institutes so they can be run more efficiently and contribute to the growth of the country's economy. The managing director and executive officers of the 19 state-owned firms have been assured of retaining their jobs following the government's decision of merging them. And S&P Global has revised down the long-term credit ratings for 3 Egyptian banks, including 2 major state-owned banks, to B- from B. The banks are the National Bank of Egypt, Bank du Caire, and largest private sector bank, Commercial International Bank. S&P explained that the three banks are highly exposed to sovereign debt, giving them a risky credit profile. And the value of the US dollar against the local currency in the Egyptian informal market skyrocketed over the past 2 weeks. It's a major blow to the country's already ailing economy. An increase is believed to be direct consequence of the ongoing deadly Israeli war in neighboring besieged Gaza Strip. $1 is officially equal to about 30.90 Egyptian pounds, whereas its value against the local currency in the black market ranges from 45 to 47 Egyptian pounds. And that's the show today. Thank you so much for watching. I'm Ladi Williams. See you again tomorrow. Bye for now.